Welcome to the Deep Dive. Today, we're cracking open a company whose products, well, you probably know them well, even if the corporate name isn't top of mind. Constellation Brands, Inc. That's NYSE, ticker STZ.
Yeah, we're talking Corona, Modelo Special, Pacifico,
Yeah,
beers you likely see everywhere.
exactly. But for you, the American investor listening, this goes way beyond just what's in the cooler on a Saturday afternoon. It's actually a pretty complex, unfolding investment story right now. So our mission today is really to put on our professional stock analyst hats. We're going to sift through the latest financials, the strategic moves, the market vibes, and give you a solid, concise understanding of where STZ stands today. We're looking at the challenges, the potential, really aiming to give you some actionable insights.
And to do that, we've really dug into a whole stack of recent financial filings, industry reports, the latest economic forecasts, and even detailed market sentiment data.
Right.
We want to connect those dots for you, give you that holistic view. Is this recent dip in the stock price maybe a buying opportunity, or is it signaling something, deeper going on?
That's the million-dollar question, isn't it? So let's start with the fundamentals. What exactly is Constellation Brands at its core?
Well, at its heart, Constellation Brands is a global player. They operate in the U.S., Mexico, New Zealand, Italy, a pretty wide reach.
Okay.
And their main game is producing and marketing premium beer, wine, and spirits. Their strategy for years has been pretty clear. Focus on those premium, high-growth brands. That's how they try to stand out in a really crowded market.
And you definitely see that premium focus in their brand lineup. On the beer side, you've got the big ones, Corona Extra, Modelo Special, Pacifico. These aren't just popular, they really dominate that premium import space.
Absolutely. And then in wine, you see names like the Prisoner Wine Company, Robert Mondavi, Kim Crawford, again, aiming for that higher-end consumer.
So when you break down where their money comes from,
It's overwhelmingly the beer segment. That's the engine pulling most of the weight, driving the growth. The wine and spirit segment, well, that's been a different story. It's been a significant challenge lately, and that's frankly crucial for investors to understand right now.
that split beer as the engine, wine and spirits, as maybe the anchor dragging a bit seems key. Let's dive into that, specifically looking at their recent Q1 numbers for fiscal year 2026, the quarter ending May 31st, 2025. What are these numbers telling us?
Well, the Q1 results, honestly, they painted a pretty stark picture. Net sales landed at $2.51 billion.
Okay.
Now, that's down 6% year over year, which is notable. But maybe more importantly, it missed Wall Street's expectations. Analysts were looking for closer to $2.61 billion.
So a miss on the top line, that signals some headwinds, right?
Right.
Stronger than maybe people thought.
Exactly. And it wasn't just sales. Net income attributable to the company plummeted, came in at $516 million. That's a huge 41% drop compared to the same quarter last year.
Wow, 41%.
Yeah. And even the comparable EPS, that's the number analysts often watch because it strips out some one-off items even that missed. It was $3.22, but the market expected $3.34. So down 10% year over year and below estimates. These weren't small misses.
That really highlights some broad pressures they're facing. But what about gross profit? Was there any silver lining there?
Well, despite those sharp drops elsewhere, their Q1 gross profit was still pretty solid, actually, $1.4 billion, roughly. And, the company's trying to manage its finances proactively. They announced back on June 2nd that they're redeeming some senior notes early, the ones due in 2025 and 2026.
Okay, so they're managing debt.
Right. It shows they're still focused on long-term financial health, even with these current struggles.
So given those overall disappointing numbers, how did the two main segments perform individually? Did Q1 really reinforce that story of strong beer, struggling wine?
It absolutely did, crystal clear. The beer segment, while it's still the core driver, actually saw its Q1 sales dip by 2%, down to $2.23 billion.
Okay, a 2% dip. Still considered robust, though.
Yeah, definitely robust overall. And they're still forecasting growth for the full year, somewhere between 0 and 3% for beer. So it's still the workhorse. But, that slight dip is something to keep an eye on.
And the wine and spirit side, what did that look like in Q1?
Oof. This is where it gets really tough. Q1 sales there plunged to just $280.5 million.
Plunge how much?
That's a 28% decrease year over year. Even on an organic basis, taking out divestitures and currency impacts, it was down 21%. There's no question this segment is the major drag on Constellation's overall performance right now.
28%. And what are they projecting for that segment for the full year?
They're bracing for impact. They project a 17 to 20% organic sales decrease for wine and spirits in fiscal 2026. That signals some really deep ongoing challenges there.
Wow, projecting a nearly 20% decline. So putting it all together, what's their overall guidance for the full fiscal year, given these struggles, especially in wine?
For the whole company, fiscal 2026, they expect total organic sales to be somewhere between a 2% decrease and a 1% increase. So pretty flat overall.
Okay.
And comparable EPS, they're guiding between $12.60 and $12.90. But importantly, they specifically called out consumer demand and the general economic environment as key risks. They know achieving even those targets won't be easy.
Right, acknowledging the headwinds. So, okay, we see the numbers, we see the big challenge in wine and spirits. How are they trying to fix this? What are the strategic pivots, and what broader industry currents are they swimming against, or maybe with?
Well, the biggest strategic move is that wine and spirits restructuring we mentioned. They completed the sale of a chunk of their lower-end wine brands to the wine group right at the end of May.
Ah, okay.
The idea there is pretty straightforward. Streamline the portfolio, get rid of the stuff that's dragging them down, and really focus hard on those higher growth, higher margin premium brands. It's a direct response to those terrible segment numbers.
Makes sense. Cut your losses, focus on the winners. But what about the bigger picture? What industry trends are helping or hurting them right now?
There are several key ones playing out. First, premiumization. That's a big tailwind, especially for their beer. Consumers, generally speaking, are still willing to pay a bit more for brands like Corona and Modelo. Quality matters.
And they're trying that in wine, too, with things like The Prisoner.
Exactly. Then you've got the whole ready-to-drink or RTD explosion, hard seltzers, canned cocktails, super popular, especially with younger drinkers. Constellation's trying to tap into that with things like Corona Refresca.
But then there's the flip side, right? The health and wellness trend. People looking for low alcohol, no alcohol, lower calories.
Precisely. That's both a challenge and an opportunity. It pushes them to innovate, but it also competes with their traditional core products.
What about the core beer market itself?
Well, a huge driver for STZ continues to be the sheer strength of imported Mexican beer in the U.S.
Yeah.
Modelo Especial, in particular, just keeps growing robustly. That's critical for them. But on the wine side, the broader industry is facing headwinds. Global wine consumption is stagnating, even declining in some areas, particularly the lower price segments they just divested. So that's a tough backdrop for their wine turnaround.
And overarching all of this is the economy, inflation, consumer spending.
Absolutely. Inflation, rising living costs. It can definitely squeeze discretionary spending. People might cut back on premium alcohol or shift where they buy it. That's always a factor.
We've hit the operations, the strategy. Let's talk evaluation. How is the market actually pricing Constellation Brands right now? What do the key metrics, especially that PE ratio, tell us?
This is where things get pretty stark for investors looking at the numbers. If you look at their price to earnings or PE ratio based on trailing 12 months TTM, earnings per share, well, their TTM EPS is actually negative, minus $2.35.
Negative EPS. So what does that mean for the PE?
It means you can't calculate it. It's undefined. And for an investor, that's usually a big red flag. It often signals major one-time losses, maybe asset write-downs, or just significant operational problems that wiped out recent profitability. It forces you to look much deeper.
Especially when you consider their history. Didn't they used to trade at a really high PE?
They did. Their 10-year average PE was way up there, around 79, reflecting really high growth expectations in the past. So having negative TTM EPS now is a major shift.
A really stark contrast. Okay, so PE is out. What about other valuation metrics? And the stock price itself, what's the story there?
Right, looking at other common multiples as of mid-July 2025, EV to EBITDA was around 16.1, price to sales of about 3.07, and price to book was 4.17. These give different angles on valuation relative to earnings potential, sales, and book value.
But the stock price performance tells the loudest story, maybe.
It really does. Over the past year, the stock has fallen about 31%. It went from around $253 down to roughly $175. That decline lines up directly with those poor recent results and all the worries about the wine and spirit segment just not turning around.
And how's that reflected in market sentiment tools, like AAII?
Yeah, according to AAI metrics recently, STZ showed very weak momentum and scored an expensive value grade.
Expensive even after that drop.
It suggests the market feels the valuation is still high given the current performance challenges, or that the downward momentum is just really strong. It's a sign of concern among many quantitative analysts.
Okay, let's shift gears slightly to the dividend. That's important for a lot of investors, especially in consumer staples. What's the picture with STZ's dividend?
Well, Constellation has been pretty consistent. They've paid dividends quarterly since 2016. Over the last 12 months, they made 4 payments.
And the latest payment?
The most recent was $1.02 per share. That was actually a small 1% bump up from the previous $1.01. So on a trailing 12-month basis, the annual dividend is $4.05.
And the yield, how does that look?
The current yield is hovering around 2.3%, give or take. Now, that's actually a bit lower than the average for the consumer defensive sector, which is closer to 2.76%.
But higher than their own history?
Interestingly, yes. It's higher than STZ's own 5-year average yield of about 1.5%. But that's partly because the stock price has fallen so much. The yield goes up when the price goes down, assuming the dividend stays the same or grows slightly.
Right, the math works that way. What about dividend growth?
They've shown decent growth over the medium term. The 3-year average dividend growth rate is 7.00%.
Okay, but back to that negative EPS we talked about. How does that impact the payout ratio? That's usually a key metric for dividend safety.
Just like the PE, you can't calculate a meaningful payout ratio when the TTM EPS is negative. And that definitely creates some uncertainty for investors focused on dividend sustainability.
Right. If you're not earning money, how sustainable is paying out cash?
Exactly. Now, historically, when earnings are positive, the company aims for a stable payout ratio. But right now, that negative earnings figure casts a bit of a shadow. The takeaway is, yes, they're committed to returning cash via dividends, but the yield is kind of meh compared to the sector, and the negative earnings introduce questions about long-term sustainability for some investors.
Okay, financials, strategy, valuation, dividend. Check.
But every investment has risks. What are the big ones investors need to keep on their radar here, both specific to Constellation and the wider economy?
Well, number one, company specific. Has to be that persistent decline in wine and spirits. That Q1 drop of 28% was bad, and reports mention large impairment charges too. If that restructuring doesn't work, it's a major, major risk.
And even the beer segment isn't totally immune.
No, exactly. We need to watch for any further slowdown there. That 2% Q1 dip, plus some chatter about maybe weakening demand among Hispanic consumers, a key group for them raises flags. And competition in beer is always fierce. The days of easy, explosive growth might be harder to come by.
Then you have costs. Always costs. Tariffs on things like aluminum for cans, general inflation hitting grain, grapes, shipping, labor. It all squeezes their margins. That's a constant battle.
And consumer behavior shifts.
Huge factor. Less discretionary income from inflation or high interest rates could mean people trade down from premium alcohol. Plus, you've got the ongoing rise of non-alcoholic, low-alc, and all those RTD options stealing share, potentially.
You also mentioned their big investments in Mexico production. What are the risks tied to that?
Big capital spending always carries risks. Construction delays, cost overruns. But specifically for STZ in Mexico, environmental and social risks are key. Remember the Mexicali plant cancellation? That was due to water scarcity concerns, and it cost them money.
Right, water is a big ESG issue for them.
Absolutely. Sustainalytics rates them as medium ESG risk, highlighting water scarcity and supply chain environmental management. And finally, on the company side, there's been more insider selling than buying recently. That can sometimes suggest mixed feelings internally about the near-term outlook.
And beyond the company itself, what about the broader macroeconomic picture?
Well, you've got the risk of a global economic slowdown. Forecasts for 2025 aren't exactly booming, which could dampen consumer confidence overall.
Inflation and interest rates.
Still very relevant. High rates mean higher borrowing costs for STZ, even with their debt management. Persistent inflation keeps pushing up their operating costs. Currency is another one producing in Mexico. Selling mainly in the U.S. means the peso-dollar exchange rate matters to their bottom line.
Any geopolitical risks?
Always a possibility. Things like disruptions to shipping routes, trade tensions. They can impact supply chains and transport costs unexpectedly.
Okay, that's a sobering list of risks.
Right.
Let's pivot now. Despite all those challenges, what are Constellation's core strengths? What gives them a competitive edge, and what internal capabilities do they have to fight these headwinds?
Okay, good question. In the beer segment, they're up against giants like Anheuser-Busch, InBev, Molson Coors. But STZ has a really distinct advantage. It's their dominance in the U.S. imported beer market. They have something like a 30% share there. And critically, their Mexican brands, especially Modelo, have this incredible growth momentum that most other big beer brands just don't have right now. It's unique.
So, a strong position in a growing part of the market. What about wine and spirits, where they're struggling? How do they compete against, say, Diageo or Pernod Ricard?
It's a different approach there. They aren't trying to be everything to everyone. Their strategy now, especially after the divestitures, is to really focus on that premium niche brands like The Prisoner, plus their craft spirits like Casa Noble Tequila and High West Whiskey, carving out a high-margin space.
So what internal capabilities allow them to pursue these strategies and weather the storms?
Well, first and foremost, that powerful beer brand portfolio, Corona, Modelo. The recognition and loyalty are immense. They're reliable cash cows. Their market leadership in U.S. imported beer gives them leverage with distributors and retailers. Their commitment to premiumization across the board is a clear strategic strength. And despite the recent earnings dip, they generate really robust cash flow. FY 2025 free cash flow was over $2 billion. That funds everything: investments, dividends, debt reduction.
And those big investments in Mexico, a strength despite the risks.
Yes, strategically vital for securing future supply to meet that beer demand. They're also making ESG efforts, sustainable packaging, reducing their carbon footprint, which helps brand image. And you can't discount an experienced management team and a strong distribution network. Those are crucial for execution.
So quite a few strengths counterbalancing those risks. Bringing it all together, how is the market really perceiving STZ right now? What are the investor dynamics?
Well, it feels like the perception has shifted. STZ used to be seen as a pretty reliable defensive consumer staple. But that big stock decline and those weak momentum scores, that image has definitely weakened.
What about the big money, institutional investors?
It's interesting. A lot of institutions still hold STZ, over 1,900 of them, actually holding more than their total available shares, technically. And buying actually increased slightly last quarter. But the overall allocation to STZ within institutional portfolios decreased by over 10%. So it seems like while they're holding, maybe they're reducing their weighting. Less conviction, perhaps.
And insider trading.
As we mentioned, net selling over the last few months. 1 buy from the chairman, but 3 sells from other key execs. It sends a mixed signal at best about internal confidence in the short term.
And analysts, are they adjusting their views?
Yes, definitely. The recent weak performance has led some banks, like Bank of America, for example, to lower their price targets or change ratings. They're citing concerns about that wine segment turnaround and the overall consumer environment.
Okay, so let's wrap this up. We've covered a lot of ground. What does this all mean for you, the American investor, looking at Constellation Brands today? Is this dip a chance to buy or a warning sign?
Look, Constellation Brands is still fundamentally a strong company in many ways. That premium Mexican beer portfolio is powerful, generates solid cash, has great brand recognition. But its Achilles heel right now is clearly that wine and spirit segment. It's just persistently underperforming.
And that's happening against a tough economic backdrop.
Exactly. Inflation, potential consumer slowdowns.
Yeah.
Those are significant hurdles that really challenge that old defensive stock narrative for STZ right now.
So for investors watching this, what are the absolute key things to monitor going forward?
Number 1, can they actually execute a turnaround in wine and spirits? We need to see real signs of stabilization and improvement there. Number 2, will that core beer segment keep its momentum going, especially with more competition and changing consumer tastes? And number 3, how well can they manage their costs and protect margins in this environment?
And the current stance: buy, sell, hold.
Well, that recent stock price drop might look tempting from a valuation perspective to some, but the weak momentum signals and the very real uncertainties, especially in wine, suggest caution is probably warranted right now. You'd likely want to see some concrete signs of improvement, proof that the strategic changes are working, before jumping in aggressively.
So as Constellation Brands gets ready for its next earnings report, the big question really hangs in the air. Will we finally see some definitive proof that the wine and spirits turnaround is taking hold? Or conversely, will we see more signs that even the mighty beer segment is starting to slow down more significantly? What are you watching for?
That's the key tension right now.
If this deep dive was helpful for you, please do consider subscribing to our show for more expert analyses like this one.